If a working person were to open a savings account or money market account today, they would receive an interest rate of between 0.15%, a tiny fraction of 1%, all the way up to maybe 2%. How would implementing a classical gold standard impact savings rates? What kind of savings returns have we seen under the gold standard in the past?
Savings rates under the gold standard generally varied between 2 and 3 and 4% in the short-term money market, and as high as 5 and 6% in the long-term market. Indeed, the long-term market for savings often was as low as 2 or 3%. It depended on the stage of the business cycle. But one thing was continuous. You always got a fair return for saving your money in the bank. And you got even more than a fair return because the money you saved in the bank today in 30 years was worth the same in its purchasing power of goods and services in the market as it was on the day that you saved it, which is the difference we face today, where you save $1 in 1970 and it's worth 15 to 20 cents in 2011. And that's as a result of the fact that we live in a world of paper money. Now, what the gold standard does, which is so different from the paper money standard, is that it creates a tremendous demand for investment because those who are taking a chance with capital, businessmen, small businessmen especially, have every incentive to borrow money because they can believe that the economy is going to be growing gradually and the value of their debts when they borrow money from the bank, they can count on what it is they're going to have to repay. Today, with the volatile dollar rising, sometimes their debts are very costly to repay. Other times, the value of their debts are falling and stimulating borrowing beyond which it should be, leading to housing crises of the past cycle. So what it does, it provides a steady, level playing field so that borrowers and lenders, savers and investors have incentives to exchange capital with one another, creates an enormous demand for investment, and at the same time, its counterpart, savings, it creates a tremendous investment to save, to provide the savings to cause the economy to grow. Well, once you have businessmen having confidence in the currency, once you have savers who have confidence in the currency, you have a prescription for full employment, demand for labor, which is generally beyond the capacity to fulfill it, and what happens is you get high and rising real wages, which is, of course, the key to restoring our economy today, because we know that real wages have been falling for working people for almost a generation. Real wages have been falling for middle-income people, those on wages and salary. Real income has been falling for everybody on fixed income who have been cheated by the long-term decline in the value of the dollar.